Hello ladies and gentlemen, this is Usman Ali, and the video which I'm recording is regarding the consolidation of a multinational corporation. So we suppose that we have a multinational company by the name of Miami & Co. It's a US based organization whose the base currency is actually the dollars, but as it is a multinational company, so they have their stakes or investments in 4 different countries with 4 different currencies actually. So for sure they have business in US. Along with that, they have business in UK, British pounds, Canada, the Canadian dollar, and then the Swedish krona, the Sweden, and the Mexican peso. So they have their businesses in 4 other countries as well. Now the corporation, the Miami Co. They are wondering to consolidate that how much would be actually their exposure in each currency and what will be their consolidated cash flows. In simple words, how much money or cash flows they will generate from all these 4 foreign sources in terms of dollars. That's they want to know. Okay, so its objective is actually first to measure the exposure of each currency. That's their first step, that they will try to know that how much cash flows or how much they are exposed to on every country or on every currency basis, and then they will combine all of them to know the consolidated cash flow that can be generated in 1 quarter actually. Now it's just basic mathematics is used, so I have solved the numerical before starting the video. So we have all the values available. I will just teach you the process, how it works. It's basic mathematics. I'm confident you can learn it by this way. So this is an easy thing. They have done their calculations on the total cash flow. So from the business in UK or the venture in UK, they are confident that they have a generation of 17 million pounds that they will generate. So it's the budgeting thing. You have your budgeted revenues and budgeted expenses actually. So they know that they will generate 17 million pounds in coming 1 quarter. Likewise, they have their budget of expenses as well, which says that there will be a cash outflow of 7 million pounds actually. So if I want to know that what would be my net cash flow, so very simple, 17 million pound minus 7 million pound, and it means that from their venture or business in UK, they will have a positive cash flow of 10 million pounds. In simple words, the company will receive 10 million pounds in this coming 1 quarter from UK. Now these pounds must be translated, if not transferred, translated into dollars term, because that would be the only form the consolidation is possible. I am teaching you, or I'm using the word consolidation with the assumption that you do understand what consolidation is. I'm referring to the consolidation of all the financial information. Now, what they have done is they have calculated their expected exchange rate. As a company, you don't need to calculate it. You can take it from any authentic economics website, international economic websites or financial websites. You can get an estimated exchange rate values. If not, then what else you can do is whenever you are doing these calculations, so you can go to any mercantile market website and you can check that after 3 months, means if that's the quarter, so the contracts of pounds are signed, the forward contracts or the future contracts actually, they are signed on what price. So whatever the price it is signed today, when you are doing the calculation, this could be also taken as your expected exchange rate, because what is future rate? That's the future expectation. So we have an expected exchange rate that in a quarter the pound value would be 1 pound equal to $1.5, and how much pounds we expect to generate. In excess, we expect to generate 10 million pounds extra than our expenses actually. So we will multiply the quantity with the rate, and it means that the company will be able to generate a positive cash inflow of 15 million pounds in the coming not pounds, sorry, $15 million in the coming one quarter only from UK. So that's this thing. First measure the exposure in each currency actually, okay? Then the company will follow the same procedure for the Canadian dollar and for the Swedish krona and the Mexican peso as well. So their cash inflows, that estimated cash inflows, are 12 million Canadian dollars, while they expect to have a 2 million Canadian dollar expenses. So their net value would be that they will generate a cash inflows of $10 million net cash flows. And it is expected that 1 Canadian dollar would be equal to 0.80 US dollars. You can write it 0.80 or you can write it like 0.80 US dollars. Once again, you can very easily get the price. You don't need to calculate it by yourself. You can get it from these authentic websites, which I just referred in the previous country calculation. And then you multiply this rate with your net value, so we get $8 million that is expected to be generated from the Canadian business venture. Likewise, you will do it for the Sweden, and you will do it for the Mexican peso as well. So now, you know the process now, that how this minus $15 million dollars are calculated and the $8 million positive value is calculated actually. So these are our individual exposures actually, ladies and gentlemen. So we are our $15 million is exposed to the risk factor of British pound. Our 8 million is exposed to the risk or the change in the value of dollars, Canadian dollars. 15 million Swedish krona is connected to the value or attached to the value of the Swedish currency, and 8 million to the Mexican peso. Remember this thing, that every country tends to have its own country risk or level of risk. So the level of risk that we have in this $15 million is probably different from this $8 million and $15 million and $8 million as well. So that's why we have done the calculations individually. Now, if I use the word risk factor, then it means that there must be a risk because of the change in the value. And $1.5 dollars equal to 1 pound is not guaranteed that actually it will be like this. It's not guaranteed. It's just an expected exchange rate. It's just an estimation. A more realistic approach would be to utilize a range. Like we have a minimum value and we have a maximum value. Okay? So what economists do is, and the government, while developing an appropriate monetary policy and the macroeconomic decisions the government are making actually, so they have a range in their mind, and that range is considered to be a suitable range by the government based on the economic decisions they are making. Okay, so let's go to a better approach where we do not rely on a single exchange rate expected value. A more realistic approach would be to rely on a range of the values actually. So for the range one, I have prepared this table actually. Our investments are in 4 countries with 4 currencies that will affect our cash flows. Then I have copied the net cash flows data that we have. This is the net cash flows data. So I have copied it from the previous table actually. And then instead of relying on one value for one currency, I have developed a range, a minimum and a maximum. Now this $1.40 per pound, it means that minimum, if the value of pound goes down, it can go down to 1.4, and if it goes high, then it can go maximum high to 1.6. Likewise for Canadian dollar, it is 0.79 to $0.81. For the Swedish, it's 0.14 to 0.16, and while for Mexican peso it is 0.08 to $0.11. So this is actually a range, and the bigger is the spread or the difference between minimum value and maximum value, the bigger is actually the risk factor also. After this, I have done nothing unique. I've just multiplied this quantity or the net cash flow with its dollar value. So 10 million multiplied by 1.4, we get $14 million. And I've again multiplied 10 million with 1.6, and we got $16 million. Then we will multiply 0.79 with the 10 million Canadian dollar, 0.81 with the 10 million Canadian dollar, and we get a minimum and a maximum cash flows or net cash flows in terms of dollars. So here we got a single cash flow, which is good. It makes some sense, but it's not the best approach that should be used because it's just the fixed value. A better approach would actually be to develop a range of it. Now from here we can get a very clear idea that okay, the business that we have, or Miami, the business they have in the UK, so from the UK business, the minimum net cash flows that they can generate in terms of dollar is $14 million, while maximum it is expected if they generate a net cash flow, they can generate a $16 million net cash flows, while from the Canadian dollar they can generate a minimum of 7.9 million while a maximum of 8.1 million. As earlier I said that the bigger the difference is, the bigger the risk is, and smaller the difference is, smaller the risk is. So notice the ranges here. The dollar cash flows resulting for the Miami, the peso transaction is wide. Look at this, from 6.4 million to 8.8 million. It's kind of, let's assume it's a big range, though that there is big values here from 14 million to 16 million. It's kind of millions involved here also. So the higher the range is, and obviously the bigger the risk factor is. While if you see here in the Canadian dollar, the difference is less, so the risk involvement or the risk of the change in the value of Canadian dollar in terms of US dollar is comparatively low. So this is how you can calculate the range of cash flows. In the first table, we just calculated the expected cash flow on individual basis, or sorry, individual currencies, okay? And this is the range of one. Now, whenever you talk about range, then we should calculate the risk factor, the variance. For that, I will record the next video in which you will get the idea. Thank you very much.